Hi, everyone. It's John Pocaroba, and it's Sunday, February 27th. Welcome to my general market update. It's been a couple of weeks, a lot of new information in the market. So let's get started. Just so everybody knows, I'm an amateur individual growth stock investor, and I'm not affiliated with IBD or MarketSmith. This presentation is made by Rain King LLC. So the agenda for today's meeting is talk about the brief picture, really briefly. Want to get into a little bit of the market sentiment, some of the internals, and then this question, that continuation of previous videos: is this a bull market correction or a bear market? And then some new information. I'm going to share some current names that are of interest at this juncture in the market. So let's go into the big picture overview. I've shared this a number of times. I won't spend too much time on it, but essentially what the slide is trying to show is that a bull super cycle started in 2009, and it's really kicked into gear in 2019 as the millennials, as a large group, 84 million millennials, has entered their peak consumption years. And the theory is that this could last for another 15 window of peak consumption, where millennials are buying houses, cars, insurance, financial services, and boomers are also buying second houses and transferring wealth to millennials. This is the NASDAQ monthly close. I've talked about how even the correction that we're currently in, we could come all the way back into the approximate 11,000 range and still be in this long super cycle bull market. This is the NASDAQ composite, a daily chart, just looking at some various zones and levels in terms of corrections and bear markets. We'll talk about this a little bit later, where we are with the S&P relative to these levels. So amidst the Russian invasion, I wanted to just touch base on war events. This is actually interesting chart I got off of Twitter. Just shows some of the major war events: Vietnam, Gulf War, Afghan War, etc. And the initiation of the invasion in those particular conflicts and what the market did. And as you can see, the market generally bottomed, or shortly after bottomed, after the actual invasion, and moved higher. This is from LPL research related to major geopolitical events such as invasions and wars. And how did the S&P do? You can pause the video player and look at this in more detail if it interests you. But the major picture that I was trying to share is, if you look at the columns for 6 months out, 12 months out, roughly 60 to 70% of the cases are green, meaning the S&P will be higher 6 to 12 months out. So you can look at that in a little more detail. It's kind of interesting as a side note. So market sentiment and in the internals of the market. This chart is the NAAIM active manager, portfolio managers, 2-week moving average of the level of exposure that active managers has. You'll notice that since November, when there was up over 100%, we've come all the way back down to approximately the 50% level, which usually is associated with corrections such as shown in yellow. And I think what's important is, the active managers are back at 50% exposure. This could actually be some fuel as money gets put back to work, at least for a rally off the undercut we had last week. This chart is the AAII sentiment survey on a very long-term basis. And what's noteworthy is that the current level of bulls is at its lowest level in over 6 years. So retail investors are extremely pessimistic right now, even more so than the COVID bear market and the lows back in 2016. So it's a real extreme level. The median gains in the S&P 500 after such extreme levels is 1 month out about a 1% gain, 3 months out 4.3, and 1 year later about a 20% gain. This is an interesting chart. This is the QQQs, and it shows the short interest in the Qs. And what's interesting about it is it's at extremely high levels, where extreme bets, bearish bets are being made. Could this be the end of the growth stock destruction? As a contrary opinion, when everyone leans to one side of the boat, the market tends to go the other way. And this is a very extreme negative reading where people are betting that the QQQs are going to go down. So let's get back into this continuation of the question about, is this a bull market correction? Is this a bear market? And what are we looking for to get some signals of either? This is the S&P 500, and I've marked the zone here from an 8% correction to about a 12% correction in orange. We came all the way down and actually undercut that level, the initial low, and we had a sharp reversal with volume picking up. So the bull market correction is still the initial premise. I shared last time, and I'll quickly overview, there's been 23 bull market corrections in the S&P 500 index and 6 major bear markets since 1971. The average bear market correction is about 13.4%, and the calendar days to reach the final low was 91 days on average and a 64 days as a median. So here we are in 2022. The S&P is currently corrected 14.6% in 53 calendar days. The NASDAQ is worse than that. It went down intraday 22.4%. The first follow-through day that we had in the S&P has failed, meaning we undercut the initial low. So let's talk about going forward. I mentioned that about 20% of bull market corrections have led to major bear markets, which are defined as a 40% decline or more. So in these 23 bull market corrections, there's been 7 examples undercutting the initial low. And the undercut average is about 2.4%. And after it undercut, it took 4 to 16 days to recover that low once you had the undercut. We had it all in one day last week where we undercut and recovered on the same day. So it appears that we're in a rally attempt and we're on day 2. So looking ahead towards potentially a second follow-through day. And when you get a second follow-through day after the first low has been undercut, what are the expectations? Well, if we get that follow-through day, the gains forward over the next 3 months would be approximately 9.8%, and they never undercut the follow-through day number 2. And if that's the scenario, it would average, historically, it averages about 93 days to get back to the new highs. Or, and it's a possibility that if follow-through day number 2 fails, then a deeper bear market is probably underway. So here's the S&P 500 on a daily chart. I had tweeted this out, I think it was Thursday. We had basically an undercut of 2.6%, which is right on the averages that I just mentioned. And we had day 1 of a rally attempt. The index was up 1.5%, but the breadth was very weak. It was only 19 to 15, so not a great sign. But day 2 of this rally attempt, the index was up 2.2%, and the breadth was much, much better, 27 to 5 to be more accurate about it. New lows, which I track pretty consistently, we had 792 right around the first low and approximately 792 in the second low. Not exactly what I would like to see. I'd like to see the new lows dry up on the undercut, but they didn't. So we have a rally attempt. There certainly is overhead resistance at logical points. We have the magenta line, the 20-day moving average. We have the black line, the 200-day moving average, and then the red line represents the 50-day moving average. So there's going to be some tests in here. It could get messy. The other thing that people sometimes look at on this rally attempt, they'll look at the volume that we had on Friday and they say, oh, geez, the volume was low. That's not a good sign. I wouldn't be concerned about the volume the first few days of a rally. What we really want to see is the volume to kick in day 4 or later when we get a follow-through day to really show some conviction behind the rally attempt. So revisiting a couple of precedents that we looked at a few weeks ago, this is the 2011 period. Just a quick recap, sharp decline lower, the first initial rally met resistance, and then eventually this 2011 had an undercut. So we had the scary undercut of the initial low, and then we had, very similar to what we had, a big reversal closing at the peak. So if you're looking at this as a precedent, maybe we're right in this area here where we're day 2 or 3 of this second real rally attempt. In the 2011 case, we actually broke some initial resistance, but we still couldn't get through the 200-day moving average. If you use the 2018 bear market as a precedent, you'll notice that after the initial undercut, we had a sharp undercut and a reversal up. And then we had the next rally attempt here. And you'll notice that this rally attempt as well hit resistance into the 50-day and the 200-day and eventually got rejected, and we went another leg lower. I just pointed out, if you're using this, we're probably in this area right here where we don't know if this market is going to get rejected or if it's going to be really strong and make a move towards old highs. So either we have to be open to. So what are we exactly looking for in a market bottom? And I'm going to share, things that I look for in a market bottom. You may have different indicators, which is absolutely fine. I try to keep it fairly simple and trust the indicators that I use. So the first thing that I'm looking for is when we get rally attempts, I want to see the breadth of the market improving. It's been a fairly narrow market. I want to see the breadth improving. And I'm looking at the advanced decline line. And I'm also looking at leading stocks and leading groups in the market. Number 2, we want to see a positive divergence, and that when the index itself makes a new low, like we had last week, I want to see fewer new lows, which is again relating to the breadth of the market and new lows starting to dry up. We did not have that yet in place. Third thing, I'd like to see a strong follow-through day. A follow-through day occurs on day 4 or later, and it's a requirement that it be at least 1.25% as a minimum. I really prefer a powerful day that's up 2 or 3% with more big volume. That would be more convincing and hopefully stocks setting up. The next serious things that I'm looking at and I'm looking for are sentiment. Sentiment being at extremes. I shared just 2 data points. One was the AAII survey, which showed the lowest level of bulls in 6 years. So that certainly is extreme. And the QQQs, very high short interest. And that also is an extreme. So I think we are seeing some extreme things relative to sentiment that would help potentially give us some fuel for a rally. Next thing is the news. The news will be horrible at market bottoms. And we certainly have a lot of concerning bad news. The Russian invasion, inflation, rising rates, and certainly growth names have been crushed. So the news is horrible. So I put a check box next to that one. The next one is growth names. Growth names have been really hit hard. But what might be an indication that things are drying up is when growth names stop going down or they actually go up on bad news. That's a sign that maybe growth stocks are becoming sold out. And without pulling up the charts, I would encourage you to go look at Square and Shop and Roku. They all had very bad earnings reports. And instead of continuation to the downside, they've actually started to reverse up and hold. So that's a sign that maybe growth is really being sold out. So that's a positive development in my opinion. It's a subtle, small item. We're looking for quality bases, and we want new names if possible, and we want to see relative strength. So we want to look at this a little closer. So I want to get into some current names of interest. First, I'm starting with the groups. I want to look at some group relative strength related to the low. So this is the point, the S&P in black. This is where the S&P undercut the January low. And this is just trying to line up what's been the strongest groups since that low. So the strongest groups, the mining, metal ores, and there's some names in there that are performing well, the leisure stocks, and lodging in particular. The computer software area, security, has shown some signs of life. And we're going to look at that in a little more detail. Particularly with the Russian invasion, computer security is going to be even more important. And believe it or not, the food and grains area has also shown sharp relative strength. So I want to go through a number of charts fairly quickly, but I wanted to give you my thoughts on why I think some of these charts are interesting. So these 4 charts, and these are all weekly charts, are all leisure names of interest. The one that I think is really the leading name is Expedia. And what I like about Expedia, well, actually what I like about the entire group is this group really started to move a few weeks ago. And the Russian invasion news pulled them back and dragged the group back down. Many of these stocks have formed shakeouts, and also including some had very sharp declines, but even more importantly, they had a very, very fast recovery, which tells me that the group is still being supported. So Expedia is one that actually had a very sharp 12% decline in 2 days, but the positive is it recovered that decline. In 1 day, it recovered 10% out of the 12% decline. Very positive, and you notice that it pulled back right to the pivot. C's base is trying to break out, pulled back a little bit. Live Nation, you can see that the obvious strong point is the relative strength line, and the last 2 weeks have been extreme big blue accumulation bars, very positive. And Marriott, also, you can see the shakeout back to the pivot and an undercut and a very fast recovery. All of these names look very interesting at this time, primarily because the group was gaining steam before the Russian invasion. The next group is security, the security software names. And really, I think the leader in the group right now is Palo Alto Networks. You can see the RS line is at new highs. And which also is really, really favored about this is Palo Alto Networks, in the midst of all this destruction and growth, only pulled back 20%, which is extremely small pullback, given most growth stocks have been down 50 to 80%. So I think that's very, very strong, the relative strength. Fortinet is also in a base, starting to come up the right side, so there may be some opportunities there. Checkpoint Software, this is a longer base, but it actually broke out last week, and you'll see the extreme relative strength as it came up off the lows of that base. It may need to pause and digest a bit, but again, it's a breakout showing strength in computer software security. I also included Crowd. Crowd has been beaten down pretty good, but you'll notice that these 2 weeks in blue right here show complete support off the lows, and you see 2 big blue spikes. So that might be a potential bottoming process in Crowd, and I included it because it is in the security group. Metals were extremely strong last week. I believe one of the leading names in the group is Tech Resources. I will disclose that I do have a position in Tech Resources, and it's currently in an uptrend. It broke out and it's trending up. Very strong relative strength line. MP is in a cup base. We'll have to see as this develops and potentially could break out. Nucor is one that I put on the chart. Now this base is very sloppy. That's a negative. So I don't like sloppy bases, but the stock did break out. The volume wasn't great, but it did break out, and the RS line has hit new highs. Steel was very strong last week, so this is one to keep an eye on. And I included Newmont Mining in the group, which is a gold stock. The reason I included it, it's forming this pretty smooth symmetrical cup, and you'll notice that the right side of this base has extreme accumulation. 1, 2, 3, 4, 5 big blue bars. And you'll notice that the relative strength lining gold, as well as the other metals, has been extremely strong. Don't know where this is going to go, but the chart is looking technically strong with good RS. And some software names of interest. Datadog is probably one of the strongest ones out there. And Datadog and Build.com, what interests me about these two names is these are the first ones that institutions started to show their hand a few weeks ago and had some extreme accumulation, some big blue accumulation weeks off the bottom. 3 in a row for Bill, 1 for Datadog. Datadog has some really good fundamentals. It's got accelerating earnings and sales, has a strong ROE, and you'll notice that the RS line is currently at 96. You don't see that in too many growth names right now. And Build.com is still building out its base. I also included 2 more speculative names, Docs and Upstart on this video, because I wanted to share a couple things related to these names. One is Docs interests me because you had a very big blue spike, had earnings, and you'll notice that the last 2 weeks, as the S&P has undercut and gone to new lows, this stock has held its gains. It's held the earning gap and it's held the gain. You can see the closes are above the initial week. That's very positive action, especially with a market that was undercutting. It's noteworthy. And some of the earnings and sales are building in this company as well. Upstart also is of interest because the chart doesn't show up, but this line that I'm showing you right here, this is the $100 price level, which is a really psychological price level. If you study history, many stocks will bottom right around a round number like 100, a psychological level. And Upstart, you'll notice that there's 1, 2, 3, 4 closes right around 100, and you've got 1, 2, 3, 5 big blue weeks of accumulation, 5 weeks off the bottom. That's a very positive sign. These charts have more work to do. I'm not saying that they're buys, but these are very positive charts that in the sense that they're coming off their bottoms. So to wrap up, I think it's a really interesting time in the market to keep observing the day-to-day actions and to be very flexible. You know, the surest way to be wrong is to make predictions and then you get your brain locked into your prediction. Like I said, this market may have a rally that fails, or it may have a rally that has more legs. We need to be open to either one of them. And most importantly, you need to preserve your mental capital. You want to have a clear head so you can recognize the next uptrend opportunity. Remember, you don't have to be the first person back in the market, but you do want to be there when the time is right. So keep doing your homework, analyze your charts, build your watch list. Let's watch what the indexes do over the next 2 weeks. That's all for now. I appreciate everybody who's joining, and those of you that provide comments, I appreciate that too. If you want to follow me on Twitter, you can see my handle right there, or just subscribe to my YouTube channel and you'll get notifications if you pick the bell. Next market update from me probably won't be until March 10th, at which time we have the IBD Boston meetup. So we hope to see you then. Thanks, everybody.